Hey guys, a couple of days ago, Vanguard sent a message exclusively to their clients, and it wasn't a political rant or same cookie cutter advice that you keep hearing everywhere else. It was the real deal, honest conversation about how the tariffs had shaken up people's portfolios and what Vanguard is doing about it and exactly what investors need to do about it. So in this video, I'm going to give you the highlights of the conversation between Vanguard's head of wealth management, Massey Williams, and their global chief economist, Joe Davis. Let's get into it. First, they talked about the market drop as a reaction to the 10% tariffs that were announced on Monday and what the next few months are going to look like. Joe made a very important comment here that many people miss, and truly, if most of this video feels like word soup that you've heard before, tariffs, inflation, GDP, this is the one most important thing that I want you to take away. It's the fact that the economy and the stock market are not the same thing. So I'll explain what this means because a lot of people get this wrong. When you think of economy, think of an engine. It's all the economic factors combined, like jobs, inflation, consumer spending, business investments. It moves slowly and shifts based on what's actually happening. And when you think of the market, think of it as the mood. It reacts quickly and sometimes overreacts. It's not based on what's currently happening, but on what investors think will happen based on today's trigger. Markets can get pessimistic or optimistic, and they can dip before the economy does, and they can also rebound before the economy does. And we have seen this before. Let's look at what happened during COVID. The stock market crashed in February, March 2020, with S&P 500 dropping 34% in just over a month. But then by August 2020, S&P 500 had fully recovered, and by end of 2020 was hitting new record highs. So the market recovered in about 5 months. Now let's look at COVID economic rebound. The US economy shrank by 3.5% in 2020. It's the worst year since World War II. Unemployment was at 14.7% in April, the highest it's been since Great Depression. Recovery took much longer. GDP, which is total goods and services we produce as a country, didn't return to pre-pandemic levels until mid-2021. Labor market recovery stretched into 2022, and some industries like hospitality and small business took even longer. So while the market took about 5 months to recover, the economy took about 2 years to get back to where it was. So when talking about the reason for such sharp drop as a reaction to the 10% tariffs, Joe Davis explained that while some level of tariffs was expected with the new administration, the scale and the scope turned out to be much broader and more intense than anticipated, which shocked the markets and resulted in this drop. Going back to the question of what investors should expect from the next several months as tariffs get renegotiated, Vanguard is expecting a mix of things and high volatility. Some areas will see higher prices due to tariffs, and some sectors will see lower prices due to less demand. And the longer the tariff negotiations take, the longer the state of volatility will last. He expects more markets outside of the US to go into recession, and he says that US is not quite there yet, but is getting close on some of the indicators. Okay, the next thing they talked about is the power that we have as investors in this kind of environment. In other words, what are we in control of when the sky is falling? And Joe recognized that we're all human and that we look at our portfolios and have valid emotional reactions, seeing our money disappear. He said that the power that we have is having counsel of a friend or advisor, and I'll add a system or a note or your favorite YouTuber to remind yourself to stay grounded in your goals. That's what's going to give you the power to succeed as a long-term investor. This doesn't mean to ignore the headlines or what's happening in the world, but it's having the ability to look beyond that and keep an eye on your goals and not react to the short-term emotional behavior of the market. The stock market is like the ocean. Some days are going to be calm and peaceful, and others will bring crashing waves. You don't have to panic every time the tide comes in. You can just learn to ride the waves. Next, Massey set up for him to talk about what Vanguard is doing to protect the portfolios of their shareholders. And just like we care about what Warren Buffett buys or sells, this matters because Vanguard manages trillions and helps millions of investors. And if they're doing something, it's worth paying attention to. So here's what he said about Vanguard's investment strategy group that helps to minimize losses. They're running their algorithms through all possible scenarios, events unfolding now, those that might unfold, and even those that we've never seen before. They use this to test investor portfolios for the short term, the long term, and anything in between. And here's the best part that a lot of people don't realize. You don't need a fortune to benefit from the strategy. For as little as 0.08% in fees, you can access Vanguard funds as a regular investor, starting with minimums of $1,000 or $3,000. I'm talking about Vanguard Target Retirement Funds, which adjust automatically as you age. I'm talking about the balanced funds, which mix risk and stability based on your comfort level. In closing, Massey said that despite the volatility, I quote, success is largely within each individual investor's control. And she shared the 4 principles that can help you stay grounded and stay the course, focus on what you can control and not react to short-term swings. The first principle is to make sure that your goals are still appropriate based on your unique circumstances. And what this means is that you can have a goal to grow your portfolio or to take on as little risk as possible. And the first one wouldn't be appropriate if you're in your 50s approaching retirement and about to stop working, because that exposes you to a lot of risk and doesn't give you a lot of time to recover. And the second one wouldn't be appropriate if you're in your 20s and have 40 plus years of investing ahead of you. This will not result in optimal growth. So making sure you have the right goals and your portfolio is aligned with those goals is key. The second principle is to keep a balanced and diversified portfolio across different classes, regions, and sectors. Diversification means you won't hit a jackpot with the best stock or the best sector, but you also won't hit the rock bottom with the worst outcome of one stock, one country, or one sector. The third principle is keeping costs low. The lower your costs, the higher your returns are. Just because you're paying a financial advisor doesn't mean that your portfolio will become exempt from the storm. And the fourth principle is to maintain that long-term perspective and discipline. Have a friend, have a coach, and have this system to use as a reminder to look past the headlines and into your future, focus on your goals, and following your individual plan. I hope this gave you guys some calm and clarity to navigate today's market. I want you to know that to keep a steady, clear head doesn't mean to not have a political opinion. But if we want to have a productive dialogue with each other and with those who see things differently, staying calm, steady, and focused on the facts is the only way forward. So my goal here is to look at the economic signals and try to help us all stay focused on what we can actually control. So stay informed, stay calm, and stay committed to your goals. Thank you so much for watching. I'll see you in the next video.